Good morning, everyone. This is Barry Knapp from Ironside's Macroeconomics. It's Monday morning, August 30th. Our note this week was titled QE Not Forever. That was released on Saturday, the 28th. I'm all dressed up this morning, having just finished a CNBC Squawk Box appearance at 6:10 a.m. Eastern. So you know what that means for me here in Mountain Time, bright and early. Our note this week and our thoughts are really threefold. We wrote a section in our note titled QE Not Forever. This was a rehashing a review of Powell's speech at Jackson Hole and where we think monetary policy is both here and in the long run. We don't believe there will be any backtracking this cycle. There's not going to be at least in this business cycle, we don't believe there'll be a QE5 or a QE6. So that was the first section. The next section of the note was discussing unwinding the Tax Cuts and Jobs Act and potential implications of doing that. It was a little bit of a review of what the Tax Cuts and Jobs Act meant, what it could have meant, and what unwinding it will likely mean, at least partially unwinding it. And then a third section on deceleration in the manufacturing sector, not because of the Delta variant, just because we've reached peak velocity in the recovery in the manufacturing sector from the double dip recession. So beginning with QE Not Forever, there's a number of key points we wanted to make. First of all, we never expected Chairman Powell to make a commitment on behalf of the entire FOMC, nor did he go ahead and do that. Clearly, he delivered, at least on the day, something of a dovish taper. But recall, and we've been very specific about this, Fed communication is only one of the three channels that affects broad risk markets and the equity market in particular. There's their communication trying to deliver a dovish taper, but then there's also that they've been buying 100% of the supply of Treasury inflation protected securities, and that's driven real rates to the historically lowest levels they've ever been at. When that ends, as was the case in 2018, both in January and then again in September, that high velocity move in real interest rates ripples throughout capital markets and is a general tightening of financial conditions that leads to risk off events. And then, of course, the third channel is the one we've talked about a lot. This is a little bit unique to us, I believe, which is the volatility channel. And this idea that the Fed's purchases of agency mortgage-backed securities, again, they're buying 100% of total net supply, suppresses fixed income volatility. You saw a big drop in the MOVE index on Friday as a consequence of the dovish taper on the day. When those purchases slow, you get a big move in fixed income volatility. Again, that reverberates out across asset classes. Equities in particular are vulnerable to this. You get big spikes in the VIX. And again, a risk-off event. So those are the channels really to focus on. One of the things we found most fascinating, though, from a long term, and this is kind of a theme in this week's note, is that we've got these near-term issues and the longer-term outlook, and they're different. We do think the Fed will taper in September on the back of, to some extent, strong house price data again tomorrow, and then another strong employment report seems likely to us on Friday. That'll set the stage for a September taper. That's a little bit hawkish in the near term, but in the long term, when Chairman Powell talked about learning the lessons from the 1950s, when the Fed went too early, our head almost exploded as we thought about our whole essay that everyone could see on the front page of our research site. We've got it outside the paywall, comparing this era to the 60s. And in the 60s, the Fed had gone through the same transition. They had moved their emphasis away from inflation towards employment. Lots of Keynesians were employed by the staff on the committee. And in the early stages of that period, when the Fed was independent within the government, not of the government, as we began to run bigger and bigger deficits through the whole guns and butter effort, the war on poverty, eventually that led to the great inflation of the 70s. So this is the trajectory we think we're on. And with Powell talking about learning the lessons of the 50s and not wanting to tighten too quick, boy, we thought that was just great, because it really does align with our longer term view. Maybe not so great if they make the same mistakes that they made later through the 60s. So that's it on that. And the papers that we read that were presented at Jackson Hole, again, were providing fairly interesting justification for an easier monetary policy backdrop. One in particular focused on labor market reallocation and how higher inflation will facilitate more labor market reallocation in the wake of the pandemic. We love that concept of labor market reallocation, but not quite in this way. So that is where the entire, academic and staff view of inflation is going. They're going to be far more tolerant of it than they were in the past. And that makes higher levels of inflation almost inevitable over time. Still, though, to our earlier point, we've been talking a lot about how different the condition of the household sector is today relative to the aftermath of the global financial crisis. We reviewed the 2010 Jackson Hole when there was a real focus on the effect of debt on the inflation outlook. We're in almost the exact opposite position today. So we don't think the Fed is going to have to backtrack. We think the Fed is going to be behind the curve through this cycle. This is why we've stuck to the reflation sectors, even as we expected a risk-off event that we still expect. So that's it on the Fed for this week. We'll see more after Friday's employment report. The next section we wrote was titled Unwinding TCJA, JA, that's the Tax Cuts and Jobs Act. When the Tax Cuts and Jobs Act was initiated, we supported the reduction of corporate and pass-through tax rates, the move from the worldwide taxation system to territoriality, the R&D tax credit, limitation of interest deduction, SALT to an extent, but we did not support the immediate expensing of capital equipment. There was really very little change in the effective tax rate of equipment going from 50% bonus depreciation at a 35% rate to full expensing at a 21% rate. And in fact, we didn't get much of a reaction of equipment investment, but what we expected to happen from that, and we thought that the individual tax rates cuts were generally economically inefficacious. They just weren't big enough to really affect activity. We thought that they were in there just to sell the corporate tax rate to the public. We think that's probably still right. We expected a pickup in investment in intellectual property products and physical structure investment. We got that for about 6 months or so. We'll explain why it didn't persist, at least why we think it didn't persist. We expected labor share of income, which was already on the ascendancy from 2015 or so, was already starting to pick up, but had been at all-time lows. And we expected stronger real wage growth, all of which we got. Now, the reason we thought that we didn't get quite the boost to capital investment or persistent boost as we expected was because the trade war caused a complete reversal of the business confidence surge that happened as a consequence of the Tax Cuts and Jobs Act. We looked at capital spending plans out of regional Fed manufacturing surveys. They surged as TCJA was working through the system, and then after its passage, and then they peaked just as the trade war with China began and went and reversed the entire move. That caused capital investment to slow. The costs we thought were relatively reasonable. Total tax receipts had been at 17% of GDP. That's about the post-World War II average. They slipped to 16.2% in the 2 years following the passage of the Tax Cuts and Jobs Act. Spending went up a little bit more because of the busting of the Budget Control Act, spending cap rates that the Trump administration agreed to with the Democrats in March of 2018. So the costs, all in all, we thought were from the Tax Cuts and Jobs Act were worth paying, but we'll never really know until and unless the Biden administration reverses them, whether this was really effective for capital spending, whether it would have led to a persistent gain. We're convinced that's the case, but if they reverse it and capital spending weakens decidedly, we'll know that they probably would have worked, and this was indeed a very good idea. Hopefully, there'll be enough pushback that they won't reverse the entire effects. We need that capital formation. We had a very weak decade of capital investment. The stage is set for a good business cycle around CapEx, but the Biden administration does risk having a worse than could otherwise be outcome if they really do degrade the effects of the Tax Cuts and Jobs Act. So that's it on that. Final section of the note this week was on the peak manufacturing recovery. And through those regional Fed surveys, we've seen a real rollover in prices paid. Prices received have continued to work their way up. So that spread between the two, which is something of a proxy for marginal costs and margins to an extent, has closed. And so you're seeing margins continue to work higher. If you look at it bottoms up through the S&P 500, it looks like that's the case through these various manufacturing surveys as well. Again, all good news, but that price effect applies that we've hit the maximum point of velocity for the manufacturing recovery coming out of our double dip recession. And that double dip recession, recall, if you followed our work, we believed that the reason that the yield curve inverted, that we were getting signals of recession in the summer of 2019 was because global trade and manufacturing was in recession due to the disruption associated with the 25% tariffs on the vast majority of Chinese imports that disrupted global trade. So the recovery had already begun out of that. The pandemic hit. That made the recovery all that more robust. We're obviously having an inflationary effect of that, but it looks like that has peaked. That begs the question, will that come at the same time that the Fed is tightening policy, and will it exacerbate a risk off? We think that is a reasonable risk, though we do think that while global trade is going to settle into a even slower pace than the 2010s, of course, the 2000s was the strongest pace of global trade growth that, at least in recent history. We do think that that whole deglobalization effect will go further, but manufacturing in the US should still be pretty strong as global supply chains are restructured. So we continue to like the industrial sector. It's going to make investing in that sector tricky for the next couple of quarters or so. You're going to want to be in stocks and parts of that market that benefit from stronger capital investment, which is really just beginning to gain momentum, and avoid short cycle type companies that will struggle with decelerating orders. So that was our message on that. So again, that's one of the short-term risk, longer-term, more favorable outlook messages, like our message about the Fed this week. So we'll be watching the housing numbers. We'll be watching ADP to an extent to get a look at small versus large business. And then, of course, we'll be looking at Friday's payroll. So you can expect a pretty good recap of that and what it means for policy and what it means for markets, any weakening of growth from the Delta variant in our note next week. Have a good week, everyone. Barry Neff from Ironside's Macroeconomics. If you're not already a full subscriber to our notes, we suggest you become one. There's lots of details to support everything I've said here. Have a good week, everyone. Thank you.